In March of this year, the CEO of NVIDIA gave a 3-hour keynote at the company's biggest conference. In those 3 hours, he named exactly 2 people. One of them was a 29-year-old analyst who, before founding his firm, worked as a beekeeper in Minnesota. Jensen Huang put the analyst's numbers on the giant screen behind him, told the room this man had accused him of underselling his own chips, and then agreed he was, quote, not wrong. Hedge funds pay this former beekeeper for research. So do AI labs. So do the chip makers. He runs no fund. He posts no portfolio. He sells one thing: knowing what's being built before everyone else finds out. In late July, his firm published a call saying Wall Street has the chip equipment market wrong by $30 to $40 billion. That call points to one company. Ticker in 3 minutes. The name is Dylan Patel. He grew up in rural Georgia in an immigrant family. His story starts with a broken Xbox he fixed as a kid. Then thousands of hours in repair forums, learning how the machines underneath everything actually work. No semiconductor degree. No industry job. After college, a 1.5 years keeping bees. His words, lost in life. In 2020, he started a newsletter called Semi-Analysis, alone. Because nobody was properly writing about how chips get made. Today, it's a research firm with staff across 3 continents, and press reports put its revenue above $100 million a year. His whole method is one question: do not ask companies what they think, count what they actually buy. His team tracks real orders at every step. Raw materials, factories, packaging, memory, power. So has he been right before? His firm called the memory shortage early, months before the memory makers confirmed it. It says it flagged shipping delays in flagship AI server racks before the companies confirmed those too. And in March, the most powerful CEO in AI admitted on stage that he was right. His July call has 2 steps. Step 1. The memory chips are sold out. Micron says its AI memory is effectively sold out through 2027. Samsung and SK Hynix warn it could run even longer, with customers reserving supply years ahead. He said this early. Now the companies themselves confirm it. Step 2. When your product is sold out, there is only one way to sell more. Build more factories. And every new chip factory, anywhere in the world, has to buy its machines from the same short list of machine makers. So no matter who builds the factory, the machine makers get paid. Now the call itself. Wall Street expects the 2028 chip equipment market to be around $200 billion. The real number, his firm says, is above $230 billion. And not just because factories are buying more machines. Machine prices are going up too. And the machine makers keep almost all of that extra money because their own suppliers can't charge them more. Within days, KLA raised this year's forecast to about $150 billion. Tokyo Electron raised 2027 by $20 billion. The chip buyers can't get enough. The makers are sold out. The money flows to the machine makers. Both steps point to one company, Lam Research, ticker LRCX. Here's what Lam sells. A memory chip is not printed flat. It is built like a skyscraper, hundreds of layers stacked, then carved with holes thinner than a hair. Lam makes the machines that stack those layers and carve those holes. Memory is moving from about 128 layers toward 500. Lam says that roughly doubles the equipment every factory needs per chip. Now the quarter it just reported on July 29th. Revenue of $6.72 billion, up 30% in a year. For every dollar of sales, it kept 52 cents. Its fattest profit in 20 years. And it told investors the current quarter will hit $8.1 billion. A jump of more than 20% in a single quarter. And look where the money came from. Lam's sales of machines for storage memory doubled in 1 quarter. The sold-out memory makers have started building. And when memory makers build, they buy from Lam first. So the timing is simple. The shortage is locked in by contracts already signed. The building race is just starting. And Lam's next report card lands in late October. Now the honest caveats. Dylan Patel runs a research firm, not a fund. He has not recommended this stock. Connecting his published research to this ticker is our step, not his. And the numbers on his firm's size come from press reports. Everything else here is public. His firm's dated call, Lam's own July report, the memory maker's own statements. So what breaks this trade? First and biggest, China. New American export rules already cost lamb about $600 million this year. China used to be over 40% of lamb sales. That's falling toward 30. If America adds more restrictions, lamb loses more of that China business, no matter how strong AI demand is. Second, if Google, Microsoft, and Amazon slow their AI spending, chip factories pause their building plans. And when factories pause, machine orders get canceled first. That 8.1 billion forecast would be the first thing to break. Third, memory companies lost money for 20 years by building too many factories, so they learned to build less. That discipline is exactly why memory is sold out today. If they stay careful and build slowly this time too, Lam gets fewer machine orders and gets them later than Wall Street expects. So watch two things in late October: whether Lam actually hits the 8.1 billion, and whether the other equipment companies keep raising their forecasts toward his number. If both happen, the forecast is coming true. If either misses, the story changes. Time for the channel scoreboard. Today's entry, Dylan Patel. And note the small print on his row. This one is mapped from his research, not picked by him. Lam Research. Ticker LRCX. The starting price is on the board on screen. Now look at the board. There are 6 calls on it now, and the pattern has not moved once. The physical hardware layer of AI. Today's entry goes one level deeper, to the machines that build the chips themselves. Different people, different methods, same floor of the economy. Every call we cover goes on the same board. Subscribe if you want to see who is actually right. Already trading on Ondo and X stocks. Through a broker, you trade market hours only. On-chain stocks trade 24/7, 365, straight from your wallet. We prefer on-chain for one reason above all. Your profits stay yours, untaxed, not financial advice. Do your own work on the price you pay.